And for more on this, I want to bring in Chuck Lieberman, Chief Investment Officer and Managing Partner at Advisors Capital Management. Chuck, it's great to have you on the show this morning. And what are your takeaways from the results we've received so far?
Well, just as you said, they reported better than expected earnings, and that's really a very positive sign for the economy and the markets. People have been nervous about the banks basically for 2 years after Silicon Valley Bank melted down in a classic mismanagement case. But they took out all the banks and shot them all, and so 23 was a terrible year for banks. They've been coming back. But the market's been nervous that an inverted yield curve, a weaker economy, could really damage profitability. And in fact, we're seeing quite the opposite. The yield curve has steepened. The banks are reporting better than expected earnings. And the outlook is very positive, especially if the new administration cuts back on some of the regulatory tape that's constraining banks. So we expect them to do well in this environment.
And of course, it looked like investment banking, trading, these all benefited banks, the big money center banks, that is, in the latest quarter, as well as the net interest income, as you alluded to earlier, Chuck. Are the banks able to move in the same direction together, or are they unique and do they move separately?
Well, they tend to move together because a lot of the driving force behind their profitability is common to the whole sector, not just the large banks, but even to a large degree, mid-sized and smaller institutions. The large banks are a bit different because, first of all, they're much more diversified, but secondly, they also have much larger capital markets activities. The smaller banks have much more exposure to real estate, and that's where there is some nervousness because of commercial office buildings, which are still struggling. But the larger banks are going to do very well if capital markets activities pick up, as they've started to do.
What does this portend about the rest of the earnings season?
It implies that the economy is doing well, and therefore we should expect good, solid earnings growth across the board. Obviously, that's a general statement. When you get into specific industries, some are doing far better than others. So there are going to be significant variations across the board. But nonetheless, the backdrop is very positive. And right now, looking at the economy, growth is solid. We saw a very strong jobs report. There's every reason to think that that's going to continue. And then we have the new administration coming in, and there are some risks there. Some of their policies do pose risks that inflation might not come down as much as the Fed wants or the market wants, and that's a problem for interest rates.
And now, of course, we'll get regional banks. They'll be reporting after we get through the big money center banks, but Bank of America this morning exceeding expectations after the other names like we've mentioned, JP Morgan Chase and Citigroup also beat. What do you expect from the regionals, Chuck? How might they be different or perhaps the same to the big money center banks?
Well, they should benefit from the net interest margin. That's again common to all banks. So they should also see improvements there. Then when you get beyond that, you get into things like real estate. The real estate market is doing fine with the notable exception of commercial office buildings, but that one seems to be bottoming out. But regional banks, of course, have a lot of local exposure. So it depends on what region you're in, what your locality is doing. If you have a lot of vacant real estate, that's a problem.
And I'm curious, in terms of your outlook for stocks, Chuck, we've had many guests on the show who have said we should expect volatility this year, but that by and large, they still anticipate that the S&P 500 will end 2025 in the green. Given these inputs early on this year, what do you expect?
Well, volatility is an easy thing to forecast. The stock market's a roller coaster. So one should always assume volatility in the market. In terms of the market overall for the year, as long as the economy is doing well and interest rates don't surge to the upside, which I don't expect, then corporate earnings is going to drive stock prices, and corporate earnings are likely to do well. I see them as doing well this quarter, but really probably gaining some momentum over the course of the year. So I'm pretty positive on the outlook for stocks generally. Within the market, you do have to look at differences that are very substantial. So we have the Mag 7, and the Mag 7 has carried the market for quite a while. But the rest of the market, the S&P 493, which is unloved and really relatively cheap, I think as long as their earnings do well, they should start to catch up.
Chuck Lieberman, Chief Investment Officer and Managing Partner at Advisors Capital Management. Chuck, thank you.
Thank you.